Hi guys, welcome back to Tax Q&A. In today's video, we'll cover everything you need to know about clubbing of income. Let's get started. Clubbing of income is basically a rule in the tax law that says you can't avoid tax by transferring your income to someone else. As simple as that. For example, if you invest money in your spouse's name and that investment starts earning income, you might think, great, now it will be taxed in their hands. But the tax department steps in and says no, since the money came from you, the income is still yours and you need to pay the tax. The idea behind this rule is to prevent people from dodging tax by simply moving income to someone in a lower tax bracket or with no tax liability at all. Clubbing of income applies when the income is being earned by someone else, but the source of that income, like the money or asset, actually came from you. Let's say you transfer 5 lakhs to your spouse's account and they invest it in a fixed deposit. The interest from that FD won't be taxed in their hands. Even though the FD is in their name, the money came from you, so the interest income will be added to your total income and taxed accordingly. Now, the law doesn't apply this rule to every relationship. It focuses on a few close ones where this kind of transfer is common. Your spouse, minor child, or daughter-in-law. However, if any of these have used their own skills and knowledge to earn that income, it shall not be clubbed. Also, clubbing only applies to the first layer of income. So let's say you give shares to your spouse and they earn dividends. That dividend income will be clubbed with your income. But if they reinvest that dividend into a fixed deposit, the interest from that FD is considered their own and it is not clubbed with yours. Outside of these 3 cases, which is spouse, minor child and daughter-in-law, clubbing doesn't apply to other relations. For example, you can transfer money or assets to your parents or children who are above the age of 18 without worrying about clubbing. The income they earn from that will be taxed in their hands, not yours. Yes, it is. If you open a demat account in your minor child's name and invest through it in stocks, mutual funds or ETFs, the income from those investments will be taxed in your hands. This includes dividends or capital gains from selling those assets. For minor children, the income is clubbed with the parent who earns more. And once it is clubbed with one parent's income, it stays that way for the following years as well. There's a small relief though. You can claim an exemption of 1500 rupees per child every year on the clubbed income, but only under the old tax regime. This is a pretty common question, especially when someone is forming an HUF. Now, members of the HUF are considered its relatives, so any gift received from a member is tax-free in the hands of HUF. So, if a member transfers any property, whether movable or immovable, to the HUF, there is no tax at the time of transfer. However, any income the HUF earns from that property, like rent, capital gains or interest, isn't taxed in the HUF's hands. It actually gets clubbed back with the income of the member who transferred the asset. But remember, if such an asset is transferred at the time of HUF formation, it is treated as the HUF's capital and clubbing will not apply in this case. Yes, if you have noticed, we keep saying that your income gets clubbed, and income here includes both profits and losses. So let's say your spouse or minor child makes an investment from the money you have given and it results in a loss, maybe a capital loss from selling shares. It gets clubbed with your income just like any profit would have been. You can actually use that loss to set off against your own capital gains and even carry it forward to future years if you can't set it off fully in this year. You report it in your ITR just like your own income. So if it's interest, it goes under income from other sources. If it's rent or capital gains, it goes on those respective sections. You just include it in your total income. But here's one important step. A schedule in the ITR called Schedule SPI, that is Specified Person's Income. That's where you disclose whose income you're clubbing and under which section. And you'll be done. Yes, if the income is getting clubbed with your income and you are the one paying tax on it, then you can absolutely claim the credit for any TDS that has been deducted on that income. Just make sure to manually enter those TDS details while filing your ITR. And there was a last one for today. If Google search is too much work for you, Quora is full of opinions, then you should check out Tax Q&A, where you can toss questions and our tax experts give quality answers. And hey, don't forget to like and subscribe so you do not miss out on what's coming next. Catch you in the next one. She sells seashells on the seashores. I should charge for every take actually. The interest from that FRAM includes एक शब्द सही बोलो, अगला शब्द गलत हो जाता है.